5 p.m. Washington time with a conversation with President Biden's chief economic advisor, Jared Bernstein. Kaylee, his take on what we saw at 8:30 this morning and are about to see in this Fed meeting.
Yep. Less than half an hour to go until the decision. Chairman Powell will take the podium shortly after that. So now we turn to a special edition of Bloomberg Surveillance with Tom, John, and Lisa.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz. Bloomberg Surveillance, The Fed Decides.
Starts right now on TV and radio for our audience worldwide. Good afternoon, good afternoon. 27 minutes out from that Fed decision with equity markets at all-time highs on the S&P 500, breaking above 5,400 and positive on the session by 1 full percentage point. What a start to Super Bowl Wednesday. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrell. TK 8:30 Eastern Time. CPI coming out cooler than expected and igniting this equity market rally and taking the bond market with it.
I liked what David Rosenberg said. You know, he said just simple as this, eureka. It's finally the first visible sign for disinflation, the disinflation crew, that now's the time, and you see it in the market reaction.
Yeah, Mike Gapen of Bank of America agrees, Bramo. Expect more deceleration ahead. One giant leap for the Fed. More evidence the first quarter was an outlier. Q1 looks more and more like a head fake based on the inflation we've had so far.
One small step for the Fed, one large step for mankind at a time we're all looking for disinflation. When you look under the hood, this is the reason why people are getting excited about this. When you look under the hood, it was auto insurance cracking. It was shelter inflation that picked up, but a lot of people picked that apart and said that that was ready to go. Goods prices basically flat. Airfares, recreation, personal services, all of the prices on those things, at least the pace of increases declined. Now the question is, let's see Act 2. What is Jay Powell going to say to actually move the markets any further other than just say, yeah, you see that? I mean, we can't declare victory, but yeah.
In about 25 minutes, you'll get a statement, some forecasts. 30 minutes after that, a news conference with Chairman Powell. Check out the price action. Let's start with equities on the S&P 500. We are positive, big time across the board. On the S&P through 5,400 at 1 full percentage point. In the bond market, the 10-year down 14 basis points. The 2-year down by almost 15. Tom, for 6 consecutive Fed days, the 2-year has rallied, and it continues today.
It's extraordinary, and the thing that's important, the mathiness I did on the Bloomberg terminal before we started, was to see, are we still in range? And I would say we are, but on a 426 10-year, you look at Ian Lingen at BMO Capital Markets, we're about a third of the way to his nirvana. We made it in, 2-3 cups of coffee. It's really moving quickly, but we're still in range. Will Jerome Powell take us out of the range and finally break through?
Yields down, dollar weaker. Lisa, euro dollar 108.39.
And now up we have Fed Chair Jay Powell. But before that, leading up to that press conference and the release of the decision, JPMorgan's Bob Michael will be with us, and Julia Coronado of Macro Policy Perspectives. They will be taking us up to that Fed rate decision at 2 p.m. Eastern. Then we will get the decision, and we will get immediate reaction from Mohamed El-Erian of Queens College, Cambridge, KPMG's Diane Swonk, and Bank of America's Michael Gapen. And finally, after the press conference, we will be breaking it all down with Kathy Jones of Charles Schwab and BlackRock's Jeff Rosenberg, and we'll be seeing if bond yields are trading around like penny stocks once again.
We can start slowly. Bob Michael of JPMorgan Asset Management with us around the table. Bob, good afternoon. It's good to see you.
Happy to be here.
What are you looking for now? It feels like the CPI report wasn't the appetizer for the main event. It feels like that was the main course this morning.
Yeah, I think there was a huge sigh of relief that came out of the Fed in Washington. I think Jay Powell is now holding all the chips. He can point to the labor market and say, hey, we're still at about 4% unemployment. That looks pretty good. We're meeting our full employment mandate. And look at inflation. It continues to come down. That glide path is intact.
Bob, I've got to ask, and I'll ask this of all of our guests today, because to me it's the arch question, particularly after Lagarde and the ECB. Are they still slaves to Greenspans measured, where once they move, they have to move and be measured and be responsible to maintain credibility? Or can they actually pull off a pre-ex post rate cut, given all the noise that's out there?
I don't think they're committed to, once they start cutting rates, they have to go in a disciplined path, either every meeting, every other meeting. I think what we learned in 2015, they cut once, and then it was another year, but well, they actually hiked, and then it was a year before they hiked again. So there's a lot of distance between Fed policy moves now. They've got a lot of tools at their disposal. We still have to remember there's the balance sheet that continues to run down.
Right.
Honestly, how excited are you for this afternoon? And I understand that you have to say you're very excited. This is going to be a tremendous decision and the most interesting news conference that we've ever seen. But, you know, kind of to the point that John was making, did the CPI report kind of take the wind out of the sails? I mean, is there anything that he can really say to move the needle other than, yeah, we're sticking with this and don't ignore us?
Well, admittedly, I'm not as excited as I was at 8:29 this morning. So for sure, when you look at the complete picture of things, it's exactly what you see in a soft landing. On some days, like last Friday, you look at the data, you can identify parts of it which looks like the economy's operating at too high a pace. And then when you look at today's data, you can look through it and find things that tell you actually things are slowing down pretty quickly. When you put it all together, this is what you get in a soft landing. And I think he's best to come in, deliver the statement, answer a few questions, and then get the heck out of there.
Well, let's see if he follows your recipe. As soon as we got CPI, I got a note from Neil Dutta of Renaissance Macro. They need to get on with it. And he said, you know, they're going to get behind. And basically nothing moves in this linear way. Would you agree that the best course of action would be to even open the door to a July rate cut?
Well, that's one of the things I do want to hear from him. I assume he's going to confirm that policy is sufficiently restrictive. I assume he's going to mention that the law of long and variable lags hasn't been repealed, and they have to be vigilant to that. Would I be surprised if they threw in a rate cut in July? Today, no. Do I think they're going to do it? I think there's less than a 1 in 3 chance they do it. I think they're very much on course for September. I think it wouldn't hurt them to see a couple months more data and then make the decision then.
So in 20 minutes, as you know, Bob, all we'll be talking about is the dot plot. And it's probably the first thing Mike McKee's going to really talk about with any detail. We're trying to figure out where that median dot for 2024 comes down to. At the moment, it implies 3 cuts for this year. Does it come down to 2? Maybe even 1. What are you and the team looking for when you get the statement of economic projections?
The dot plot will be great. 2 is pretty much the expectation. It's our expectation. If it's 1 cut this year, then it tells me they actually don't look at the data and then go back and revise their dots. That once they're submitted, that's it. And if it's 3, it tells me, well, actually, they do take a peek at the data, and then they have until 2 o'clock. Maybe they'll go in and revise some of their dots.
So you're saying that it should be 3? Based on the data that we've gotten?
No, I'm saying that it should be 2, but if it's 3, it's because there's enough of the group in there that takes comfort from the slowdown. Probably they parsed through a lot of the labor market data, and they looked at the household versus establishment survey, and they're putting a little bit more weight on the household survey. So I can understand how you could have 3 dots, but I think we're going to get 2 rate cuts.
Pause, what you just said. Do you think they put more weight on the household survey? Unemployment up to 4%. I just wonder what you think that means for their forecast, because right now they've got year-end unemployment of 4%. What's that coming up to in 20 minutes?
I think it will tick up to 4.1%. We spend a lot of time looking at the household survey. What jumps out at us is over the last year, the increase in unemployed is just over 500,000, and the increase in employed is around 300,000. So there's a weakness there that's not reflected in non-farm payrolls.
So 272,000 overstates the strength of the U.S. economy, your view?
Yes, I think it's one metric of the strength of the labor market. There are a lot of other metrics to look at. I think when you look at the quits rate, you look at a lot of the JOLT surveys, when you look at average hourly earnings and how those are coming down, there's a lot of things in there to tell you that there is some capacity being built into the labor market.
That would be quite a statement if Chairman Powell echoes that in the news conference a little bit later on this afternoon.
It would open the door to a July rate cut. That is what I think.
You think so?
Yeah. Well, at least it would raise the question of just how many rate cuts they could go for if they start to say, actually, we are seeing a deterioration in the labor market at the same time that inflation is coming in.
But
rapidly.
he doesn't need to do that. He could say for the 30th consecutive month, we've got unemployment at 4% or lower. Inflation's not at our 2% target. It's coming down towards it. It's not there yet. There's no reason to do anything right now. I'm going to the beach for the summer. Let's check back in September.
You're doing that, or Chairman Powell is?
Maybe we both should do that.
Maybe we should all be doing that.
Will you join us?
I'm happy to come, Bob, so long as you're paying for the house. Bob Michele at JPMorgan Asset Management is sticking with us. That decision is 18 minutes away. That would be quite a statement if he puts more weight on that and says it explicitly in this news conference.
Well, that would give some dovish fuel to the rally that we've seen in bonds, which has been what we've seen, frankly, in the past 5 times he's spoken.
Amazing. Make it day 6 potentially. Yields are down by 14 basis points on a 2-year. Every time they meet, this 2-year just rallies. And it's happened again for a 6th consecutive meeting. Coming up very shortly, we'll catch up with Julia Coronado of Macro Policy Perspectives. Your equity market at all-time highs. This bond market absolutely ripping. Live from New York. Good afternoon.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
The Fed's not going to move. They can hold off.
Higher rates are working to bring down inflation.
The policy is working.
It feels like immaculate disinflation.
It is immaculate disinflation.
They're going to try to sound neutral.
They'll continue to say they're data dependent and that the data is murky.
Risks are skewed toward that 1 cut, 2 rate cuts.
1 or 2 times.
I don't think the market really cares whether we're going to get 1, 2, or 3 this year, as long as the next move is down.
The question is going to be September or December.
They're still going to be able to cut in September.
Cut in December. September and December.
September or December.
Trying to guesstimate that first move by the Fed, it's been a losing game. We tried, we missed. Others have tried, they've missed. The Fed's tried, it's missed.
Each individual Fed commentary will be far less important than the sum of all of their parts.
We're going to have to see what they say.
15 minutes away, we'll find out what they've got to say. That Fed decision just around the corner. Equities going into it, sitting at all-time highs on the S&P 500, on the Nasdaq. Quite a rally this morning and into the afternoon. On the S&P up by more than 1 full percentage point. On the Nasdaq up by 1.4. The Russell, the small caps up by 2.6. Thank you to the Treasury market. 2-year, 10-year, 30-year. Look at this for a rally. Yields aggressively lower. We're down by double digits across the board from the 2-year out to the 30-year. TK, the 2-year down 14 to 469.
Stay on this board. This is a really important board here on the 2-year yield to see it in 14 basis points. What's important here is everybody stews on this after the shock at 8:30 is the yield has moved further lower. John, it's out 3-4 decimal points, but nevertheless, there's a small oomph into this 2 o'clock decision here with the yield market betting lower yields, higher prices.
When this dropped at 8:30 Eastern time this morning, Lisa, we both said, let's see if it sticks. It's stuck all through the day.
This is the biggest decline in 10-year Treasury yields going back to December. We are looking at basically the biggest move since the pivot that Jay Powell put out there at the end of last year, which raises a question. Is this sort of a new sort of acceptance of the Goldilocks soft landing scenario that you're seeing certainly play out in the Russell 2000? How can Jay Powell add to that? Or does he just basically do exactly what Bob Michael just auditioned for, saying basically, it looks good, yep, we're on track, we're still wary of risks, and thank you, goodbye, I'm done.
Do you remember the last time the Fed met and I said it's whatever time it is in Tokyo, and they're very happy over at the BOJ and the Ministry of Finance? I can tell you over in France, they need to thank the CPI report in the United States because that triggered a move in the French bond market as well. Yields across the curve, lower in France, and a euro positive as well after being negative for the last couple of sessions. Just check out euro dollar. Dollar weakness today against the euro. Lisa, 108.39.
It kind of makes all of these efforts, especially by Emmanuel Macron, the press conference, all the rhetoric, the politicians, how much does that basically undermine all of that and the influence when in one session a CPI print can just completely undo it?
Joining us to discuss is Julia Coronado of Macro Policy Perspectives. Julia, that decision 13 minutes away. What are you focused on in the projections we'll get from the FOMC a little bit later this afternoon?
Well, I think as you guys were discussing, the data this morning is probably more important than what the Fed is going to tell us because this is a data-dependent Fed. So I think based on what we saw this morning, more likely we get a 2-cut baseline rather than a 1-cut. And Chair Powell, I think he's going to try to avoid sounding as enthusiastic as he did last December and encouraging the market to keep running, and instead say, look, we still have some wood to chop here. This is definitely encouraging. We still think the tilt towards rates is downward, but we're not in a rush, and we're going to gather a little bit more data. Julie, I do think he has to take out that reference to lack of progress. We clearly are back on a path of progress, and I think they're going to acknowledge that.
How is economic growth? We've had this wonderful discussion. It's a parlor game, and I love the video that we had, September, December, see you in December, whatever the song was. Julia, Jim Bullard today of Purdue said he's got a 3.0% unemployment rate in West Lafayette. They can't get help at Harry's Chocolate Shop. SK Hynix of South Korea is putting $4 billion into Western Indiana. Is this a boom economy that Chairman Powell addresses this afternoon?
Well, I think the way to resolve what the tensions you've just outlined is exactly what we've seen, which is a pickup in immigration. And that immigration is allowing the labor market to come into better balance. It's alleviating some of those shortages. And it's also alleviating some of that potential for inflation pressures coming from the labor market. So that's all kind of great from a macroeconomic standpoint. And Chair Powell has acknowledged that that has changed the way they think about growth potential. You know, growth potential of 1.8%. Well, that assumes very little population or labor force growth. That basically assumes about a 1.5% trend productivity growth rate and 0.3% population growth. We're running stronger than that. Labor force growth is running stronger. Immigration is fueling it. And, you know, I think that boosts what we can see without causing an inflationary panic on the part of the central bank.
Julia, what do you think that's going to mean for the statement of economic projections? Do you think that the inflation forecasts stay the same? Does the unemployment forecast stay the same, to be basically the same as where it is right now at the end of this year?
I think they're going to have to bump up the unemployment rate forecast at 10. Again, basically saying that we've loosened, but we don't expect a lot more loosening from here. On the inflation side, it's a bit tricky, and they will have an opportunity to update after this morning's data. Probably a lot of them are going to take advantage of or took advantage of that opportunity. You're probably going to see a little bit higher, maybe a tenth higher relative to the March projection. But today's data is a perfect example of how quickly things can change. Just as they changed in Q1, they're reverting back in Q2 with equal force. So those projections are only as good as the data ratify them.
Things have changed a lot over the last few days. It was only Friday we had that hot payrolls report, which we can talk about more in just a moment. Can I ask you about that? Actually, Bob Michael suggested that maybe this Federal Reserve puts more weight on the household survey. I just wondered, Julia, whether you'd echo those comments.
I was taught at the Fed to put equal weight on payroll and the unemployment rate. So both of them are telling us something about the labor market. And again, I think the way we square the circle is immigration, that you have a higher break-even run rate on payrolls required to keep the unemployment rate steady. So we don't take the jobs numbers at face value from the household survey. That's subject to population growth assumptions. But the unemployment rate is informative. And so it tends to be more robust to those population growth assumptions. So I think what we see is a labor market that has loosened from the tight labor market of a year and a half ago, but it's still healthy. It's still got strong legs, and what we've seen in the payroll survey that I like is the broadening out of hiring. It had narrowed down to 3 sectors in the second half of last year. We're getting a little bit of a broader base this year, and I think that's good news.
Let's bring Bob back into the conversation. Bob Michael, is that how you square the circle?
Yeah, I guess the question I have for Julia is which one of the surveys, the establishment or the household survey, captures the immigration surge that we all understand is occurring? Where is the immediate impact felt first?
So it's a great question, and the answer is really complicated, but I think in general, the payroll survey is thought to capture people that are earning money in the labor market in real time. Again, the household survey is a smaller survey, and the numbers of jobs really hinge on, they're applying the responses to an estimate of the population growth. So they're undercounting immigration. They're more likely to undercount immigration because they're basing it off stale estimates from the Census Bureau. And meanwhile, the people earning money do show up on payrolls. Again, undocumented workers are undercounted in both, so it's a bit of a complicated story. But I think there have been some analysis out of Brookings and former Fed economists that kind of come to that conclusion that probably payrolls is picking up the immigration story better.
Bob Michael, when you talk to your short-term paper people, are we anywhere near close to where the joy of 5.x% money market funds drifts away? I mean, how much do we have to come down? How much does Jerome Powell have to jawbone us to where there's a rush of money into your world?
Well, I think once we see the first cut, then the market will start to project series. Then we'll all go back and say, hey, we
need a cut.
On average, they cut 200 basis points, and that will get money pouring in. I think for the yield curve to make sense, we've got to bring the Fed funds rate down to about 3 3/4, 4%. Then to me, the 5 and 10 year makes sense where they are. That doesn't mean once the Fed starts the rate cutting path, that money won't come pouring into the bond market and drive yields much lower than that, maybe through 4%. What I'm hearing when I talk to clients is there is a ton of money on the sidelines. Some of the biggest investors haven't come into this market yet because of the inversion of the yield curve and what it does to their investment dynamic.
At this point, Bob, isn't duration better than credit, given how tight credit spreads are? We were talking to Woody Caesar earlier this morning. And if you really do believe that a rate cutting cycle is getting underway, why not just go long duration at this point and forget credit, given how it's basically rallied so dramatically?
I have completely the opposite view. As I was listening to Julia, what I heard was the balanced labor market is the stuff that soft landings are made of. And here we are gliding right into it. And you have nothing to fear in credit in a soft landing. Corporate profitability is great in the investment grade space. We already know defaults are close to zero. Nothing's going to be under pressure. So can I see Spreads coming in from 80 to 90 basis points where they are, for sure. Can they go down to 60 basis points where they were in the 95 to 98 soft landing or 04 to 06? Absolutely.
Julia, I wanted to give you the final word. I wanted to borrow a question from Lisa from earlier this morning. Do you think there's someone on the FOMC who's shouting mission accomplished based on the last couple of months?
No. Central bankers don't shout mission accomplished.
They whisper it.
They go home to their spouse and sit down and have a quiet glass of wine and cheers with each other. They're not going to come out and say mission accomplished ever.
Julia Coronado of Macro Policy Perspectives. Julia, thank you. I'm just wondering how many quiet glasses of wine have been had. That's all. I'm just wondering.
It's just like a general feeling of quiet joy that they restrain with a little smile.
Remember where Chairman Powell was at the end of last year, right? And then we had this Q1, hot inflation story. A lot of people lining up to say that's a head fake based on the last couple of months. Do you think Q1 was a head fake based on what we've seen so far?
I think so, and there was a lot of discussion about that Q1 tends to run hot relative to the rest of the year. In terms of the Fed high-fiving one another, I caught this morning with Jim Bullard on. I don't see him doing laps around the Fed,
I didn't hear it either.
high-fiving everyone.
I didn't hear it either.
Yeah, go ahead.
Can we have a surveillance correction? Julie doesn't have a glass of wine. She has a Lone Star long neck out of the tradition of the University of Texas. But no, I don't think they're anywhere near celebrating. But after the shock of these other banks beginning to cut, they're behind. That's, to me, the lead story here.
They still have work to do. And this, to me, is the big takeaway. They have work to do when it comes to credibility. And the hard work begins now. How do they finesse this at a time of political polarization, at a time where they're going to be accused of all sorts of things? They might have achieved something on the economy, but credibility is still a question that they need to answer at a time where a lot of people are calling it.
There's a word you'll hear in this news conference repeatedly, which is confidence, and we need more of it. How much more confidence do you think they need? How many CPI reports is that? No doubt that you'll have a reporter in the news conference that might ask the question. How many more do you think it is?
Not many. They have to be relieved. If there's one emotion, that has to be it. Things continue to play out the way that they had hoped. I think they'd like to see just a couple more months of employment not getting hotter, maybe a little bit of capacity building in through immigration, and prices staying about where they are. And then I don't think they're going to wait for the 2% inflation target to be hit. I think then they'll talk about the long and variable lags and begin fine-tuning policy with a rate cut.
I started the show this afternoon by quoting Mike Gapen of Bank of America, but I left off the conclusion. I'll share the quotes again. This is what Gapen has to say. One giant leap for the Fed made Bramo laugh. More evidence that 1Q was an outlier, but still thinks the first cut comes in December. Even with all that really constructive language about what we've achieved this morning, at least what they believe we've achieved this morning, Bank of America still believes the first cut comes later this year, in December.
It sort of goes to the question that we don't know what confidence means, right? We're going to be parsing through every iteration, every word. If they need confidence, Bob, you were saying it doesn't have to be that much. But Tom, at a certain point, do they have to have more confidence given the noisiness, the speed bumps that you've seen along the way?
They're going to be exposed. I don't see many speed bumps. I see nominal GDP 5%. You help me with Michael Ferroli. Maybe it's 4.8%, whatever. But there's an underlying animal spirit that belies whatever first quarter GDP was, 1.3, 1.4%. There's more of an enthusiasm now that gets them in control to where to what they want to get. Maybe they didn't have control last meeting. He's got more control of the dialogue this meeting.
That decision is about 30 seconds away. Let's go through the scores going into that decision. Equity markets right now on the S&P 500, record highs. On the Nasdaq 100, record highs. On the Russell, a rally of 2.6%. In the bond market, which is where the fun and games have really taken place over the last couple of weeks, Lisa, back and forth, one narrative to the next, back and forth, day after day, from data point to data point.
Jim Bullard saying it concerns him, the idea that we're not seeing any kind of stability in the bond market. At what point does it become disruptive? Right now, we're still seeing that massive rally on the heels of a really positive CPI print.
With your Fed decision, here's Mike McKee.
2 dots, no rate move. The median of the 19 Fed officials' projection for rate cuts this year moves to 2 from 3 in March. Policymakers are quite divided, however. 8 members see just 2 cuts this year. 7 see only 1. 4 vote no change. They now have 4 penciled in for 2025. Although the range is so wide, it's almost meaningless. The neutral rate also moves up. The median now 2.8% from 2.6%, although they don't get there until after 2026. 9 members see neutral as 3% or higher, 1 as high as 3.75%. The Fed's target range stays in the range of 5.25% to 5.5%. No change in the 2.1% GDP projection for 2024, 2% for next year. No change in the 4% unemployment forecast for this year, though 2026 moves up a tick from March to 4.2%. It's PCE inflation where we see the biggest change in the forecasts. Headline of 2.6 this year, up from 2.4% in the March projections. Next year, 2.3 from 2.2. Core PCE is forecast at 2.8% this year, up from 2.6%. Next year, also 2.3 from 2.2. Inflation was the only significant change in the statement following today's better-than-expected CPI. The statement now says, in recent months, there has been modest further progress toward the committee's 2% inflation target. The decision was unanimous.
Mike McKee, thank you, sir. If you were looking for fireworks in financial markets, you missed it all. It happened about 6 hours ago at 8:30 Eastern Time. And the equity markets, some of these moves stick. On the S&P 500, still positive by about 0.9%. On the Nasdaq, up by more than 1 full percentage point. 2-year yields, Lisa, just off the lows of the session, but still down 12 or 13 basis points to 470 on a 2-year.
There's nothing that would really shake up what we saw earlier. It is interesting, though, that they did increase their expectation for core PCE inflation to 2.8% versus 2.6%. And it raises the question about the idea of, are they tacitly allowing inflation to go be 2-point-something, to Mohamed El-Erian's point, rather than exactly 2%, as they allow this to happen even with 2 potential rate cuts baked in?
TK, what's your takeaway?
My takeaway here is that 8:30 was really, really important, and it moves us right on to all the other economic data. And I go back to economic growth, and it's a surprise this year that we get more buoyant economic growth than a lot of the gloom crew's talking about.
I want to get back over to Mike McKee. Mike, just briefly, just work through that again for us. Explain to us where that median dot is. We were looking for 3 cuts in the median dot last time around. Where's that median dot for 24 now?
The median dot is at 2 cuts for 2024, 4 for 2025, but the range has narrowed considerably, but still broad, because there are, at this point, 8 members seeing 2 cuts this year, so that makes it the median. 7 saw only 1, and 4 voted for no change. So they seem quite divided, which would suggest that at this point, there is no consensus on the committee about what's going to happen the rest of this year.
Mike McKee, thank you, sir. Mike McKee will be in that news conference in about 27 minutes' time when it kicks off with Chairman Powell. Bramo, any early questions for Chairman Powell in this presser based on that?
Yeah, I do. Number one, how long will you tolerate inflation above 2%? How quickly is an okay pace to move to get inflation down? And the second thing, I'm still thinking about this. One participant had a new neutral rate proposal of 3.75%. That's pretty bold. I mean, it's pretty much in line with where markets are for 3.5%. Nonetheless, that resets a lot of questions about market valuations that maybe on the margins could really change investment theses.
Joining us now to discuss is Mohamed, El-Erian of Queen's College, Cambridge. Bob Michael of JPMorgan still around the table with us. Mohamed, I want to come to you first. Get your view on these forecasts based on what we learned early this morning at 8:30 Eastern Time.
So I wonder, John, whether those forecasts fully reflect this morning or whether they were finalized before this morning. I was surprised to hear that 4 voted for no cuts, and I was surprised to see the inflation numbers go up. Both for the PCE, both at headline and core. So the one question I would have for Chairman Powell is, do those numbers and the expectations that 4 people had of no rate cuts reflect this morning's inflation data or not?
Mohamed, Tom Keene, good morning and good afternoon, I should say. Good late afternoon and evening to you. Somebody today echoed Peter Orszag, a long time ago of LSE. That's a school a Mohamed southwest of Cambridge. And Peter Orszag talked about glide paths. Is our great underestimation that the glide paths to get out of the pandemic with all this monetary policy is a much longer time frame than we think? We're modeling Fed meeting to Fed meeting, the silliness of September and December, where we should be modeling 2027.
We should, Tom, and I've been urging to combine data dependency with more of a forward-looking view of the economy, but that's not where the Fed is, and as a result, that's not where the markets are. The markets are reacting to every single data point. In the last month, just the last month, 10-year yields went up 30 basis points, came back down 40 basis points, went back up 20 basis points, and came back down 40 basis points. And what you realize is that there's no anchor. There's no longer-term anchor to markets, and there's no longer-term anchor to policies. We should be talking about the big secular changes and how that's going to impact the next 12 months, but that's not where the Fed is, and therefore that's not where the markets are.
Right now, I wonder how significant it is to you, Mohamed, that we did see at least one participant materially mark up their long-term neutral rate as people try to understand what this means longer term for what a Fed rate cutting path could look like.
It's about time. I mean, you know, there is a very active discussion of what's happening in the structure of the economy and why it is that the neutral rate is well above 3, nearer to 4. But the Fed is moving very slowly on this, and Fed Chair Powell has refused to engage in discussions, either saying, I don't care about it, or I don't have a view about it. So, yeah, it's about time. They're going to have to really think about this. But again, Lisa, that is a forward-looking parameter, and this is a Fed that focuses excessively on the past and doesn't want to signal much about what's ahead.
So if you are just joining us, welcome to the programme. Equities still firmer by 0.9% on the S&P 500. We were higher by more than 1 full percentage point. Just undoing some of the moves in the bond market on a 2-year yield. Yields are lower still by 12 basis points. They were lower by a little bit more than that earlier on. There was a lot of interest in the median dot for 2024. Just want to clarify something that Mike was saying. They're now signalling they expect to cut rates only once this year, compared to the reduction of 3, which was kind of signalled back in March, Bramo. So that's the change we were looking for. Would we come down for 2 or to 1? It looks like we've come down to 1, but 2025 kind of makes up for some of that in some way.
Which is what some people were saying, is that you just basically push it out to the following year, which is why it might not have been a massive deal. There was a big question before this whether or not it would matter to markets on the margins. Maybe you take back some of the gains in certain bonds right now. Nonetheless, not a huge shift when you look at the overall cutting cycle.
Well, Michael, I've got the 10-year yield just touching 2 standard deviation move. It's not a big deal, 4.28%. And gyrating around. What level of 10-year yield do you need to really signal, to use Bullard's word, a new regime?
It's not so much the 10-year yield as the front end of the curve.
Okay.
I think the front end of the curve, you've got to see the Fed start cutting rates and then the front end start coming down towards 4%. I think that will pull the 10-year down as well a little bit, but there's an awful lot priced into the 10-year part of the yield curve.
It's an unfair question. I'm going to ask you to speak for Michael Ferroli and Kasman and the other economists at JPMorgan. Did they do harm to the American economy by being ex post and delaying? What would your economists say?
They do no harm to anyone, that I'm pretty sure of. Look, I think when you look at market movements, you have to understand that there are different constituencies that are involved. We talk to a lot of very large plans that are waiting for the yield curve to disinvert because based on their investment analytics, it doesn't make sense for them to come out of cash into the longer end of the curve. There are other buyers out there that are looking to park cash into safe dollar assets. So they're big dollar buyers, they want to own the dollar, and treasuries are the largest, most liquid way to do that.
I have to say, I'm parsing through the statement and all the details, and it's a confusing one. So let's just go over it. 4 Fed officials see no rate cuts this year. That is up from 2 officials in the March projections. So that is a more hawkish tilt. 7 see 1 cut, while 8 see 2 cuts. Honestly, we're looking at right now a narrow majority seeing no more than 1 cut this year as a base case. This, according to the statement, I'm looking at this and I'm wondering, John, all the people who said this would be some kind of massive shift, it isn't being taken that way by the market as people parse through the longer term expectations for what the Fed hopes to accomplish and where the balance of risks is.
Because we had a soothing number at 8:30 Eastern time. I think that's kind of the takeaway. Yeah. Is that right, Bob?
Yeah, I think so. It's what I started with. This is what you look for in the numbers. If there are a lot of people clustered around one dot, then they don't change their projections after the number. They've submitted them, they let them go. The fact that there were 4 with no change, 7 with 1 dot, and only 8 with 2 dots, 2 rate cuts, tells me that they submit them, they don't do anything. The statement's completely different. The statement talks about modest progress continues to be made on inflation.
Let's get Mike McKee back into the conversation before Mike goes into that news conference. Mike, just to clarify some of the comments you had earlier, your thoughts?
Well, I misspoke, but 1 cut is the median dot this year for this year. But it is, as you say, somewhat confusing because of the way they do it. But looking out over the course of the year, the question is, when do they do it? Because their PCE projection is basically for the year where PCE is now. So that's going to be a question for Jay Powell in his news conference.
Mike, you get into the presser. Thanks for your time, sir. Happens to all of us. Looking forward to your coverage in that news conference with Chairman Powell a little bit later. Diane Swonk is with us from KPMG. I want to bring her into the conversation. Mohamed's still with us, Bob Michael as well. Dan, you've had about 15 minutes, 10 minutes or so to go over these numbers. What jumps out for you?
Well, certainly the upward rise in inflation I was surprised at. I expected them to mark down inflation a little bit. So that is one that I think Mohamed also flagged. But I think what's important is we know that they've delayed the marking down of their dots on the dot plot, and that has become more of an iterative process to reflect more of a consensus of what they do talk about at the meeting. So I'm not sure that there's the dissonance there that some would like to see in those numbers between today's data and those actual dots. I think what it probably did was took out of play some people who might have had hikes in their interest rate scenario for 2024 that then moved them to the zero portion, those 4 people who voted for no change in rates. But I think that's very important, is that the Fed has also been very careful not to declare victory, as Julia said at the end of the last show. And I think that's really important. They don't go out and say mission accomplished. They are very deliberative right now in terms of not getting too far ahead of themselves until the data comes to them. Now, I disagree that that's, sort of neutral and doesn't cause any harm. Data dependence, the data are lagged. And so by the time the data comes to you, even if you're willing to settle in to a higher rate ultimately, it's still lagged, and it could be after the fact. And I think that's what you see in terms of the nervousness with Jay Powell, because he worries much more than some of his colleagues about over-tightening.
Diane Swonk, I look at where we are, and what the key thing is, as Bob Michael said, is we're beyond the first quarter of this year, the lethargy, the slowdown, maybe some of the fear of the first quarter. What is your take on the state of the American economy as they stagger to September and December?
Well, we're still in an economy that's generating a lot of jobs. The household survey and the establishment survey aren't quite synced up. They haven't been synced up for a long time, in part because we're undercounting the number of immigrants in the country, and that's not fully showing up in the household survey as well. But we do know that we continue to generate jobs, we continue to generate paychecks, and if the last month's report is to be believed, and we have to be careful on that we actually saw an acceleration in wages. That's something to sort of, I think, take with a grain of salt. But at the end of the day, this is an economy that for the moment is still hanging in there, although slowing from what was a stunning pace in 2023.
Mohamed, I'd love to bring you back in here. I'm just going through all the different statements, and this is a mess. I mean, in terms of all the differing views, this is not a consensus that you could see that was easily reached. Maybe there it is for right now, but later in this year, what the balance of risks here here really is all over the map when it comes to the different Fed officials. Do you think that there is too much hawkish talk right now and too much hawkish projections at a time when it seems like the Fed is saying we still haven't done enough, we want to get to 2% a little bit sooner, even as we acknowledge this is going to be a battle?
Yeah, I think if you were to take the SEP and the statement fully on face value, this would be an overly hawkish policy stand for this economy. Among the other things, the fact that we are now at one cut means that given that the Fed will not want the stop, go cycle, that means that cut comes late in the year, very late in the year. And I agree with Diane, it does matter when you start the cutting cycle. It really does matter. It matters for small businesses, it matters for low-income households, and it matters for the economy. So if you were to take this at face value, then the market would be selling off right now. But it's not for good reason, and that's what I said earlier, and Bob mentioned it as well, is I don't think this fully reflects the latest set of data. And given that this is data-dependent Fed, if the data had happened yesterday or the day before, the S&P would look very different than it is today. And that's why the press conference is going to be so critical. And that's why Chair Powell cannot do what Bob wanted him to do half an hour ago, because he's really going to have to explain things now.
So, Mohamed, based on the guidance we've got in our hands at the moment, it sounds like December. Are you telling me by the time this news conference finishes, it'll sound like September?
I suspect so, John.
Bob, you agree with that, don't you?
Yeah, I completely agree with that. And I think Diane and Mohamed point out a very important thing, which are the long and variable lags are real. When we look at lower and middle income households, when we look at small businesses, they're struggling with the high cost of everything. They're struggling with the much higher cost of financing those higher prices. And you're seeing it in delinquencies, you're seeing it in charge-offs and write-downs and losses.
Right now, I'm looking at some of the commentary. Some people saying that the reason why there was a hawkish tilt was because of PTSD from the first quarter. Diane, I'd love your take on this. Do you think, and not to be all conspiracy theorists, but do you think that any Fed officials thought to themselves, we should probably be hawkish just to offset the inevitably dovish message that we're going to get from Fed Chair Powell later today, and we can frankly offset that later this year if the data comes in such?
Well, no, I don't think that's the case, just because I just don't think they think that far ahead on this, and I think that's important. I do think that part of what we're seeing here is, yes, they did go in to this meeting with a hawkish tilt and then in the data surprise, but we know that, Chair Powell has really changed the dynamics of the SEP, and I'm just surprised that given the timing of when they write this down, and the Fed had this data, a lot of the Fed had this data last night, so they've been looking over it, and came in strong with how they were going to talk about it in the morning, and I think they still have members of the board itself that would have gotten the data that would have said, hey, we're still on the sidelines here, or one cut and that's it. So I think that's an important way to be thinking about where they're at, about what they think they need to be convinced on inflation coming down, not to get to 2%, to cut before they get there, but how much they need to be convinced. That's a lot, and I think they've set that bar pretty high, and it's because they have been head-faked in the past. That doesn't mean we couldn't see some big improvement and get to a September cut, but I think we need a lot of improvement from here for the Fed to feel convinced to do a September cut.
Suddenly this news conference in 12 minutes got a lot more interesting. Diane Swonk of KPMG. Diane, thank you, as always. If you are just tuning in and you missed the Fed decision, it took place about 18 minutes ago. Rates unchanged, as expected. Big focus on the median dot. Basically, all the Fed officials get together. They plot where they think rates should be, will be for 24, 25 and beyond. You take the median dot, and a lot of people on Wall Street see that as a signal of how many times they're going to cut in any given year. That median dot was at 3 cuts for this year. It's come all the way down to 1. Worth noting, though, that they now see 4 cuts in 2025, more than the 3 that they previously outlined. So they've pushed some of that into next year. But the range of views, I think the median marks a very, very divided Fed. And Lisa did a fantastic job of that a little bit earlier, really explaining it, Lisa, that 4 policymakers see no cuts this year. 7 anticipate just 1 reduction. 8 are looking for 2. That's a Federal Reserve that's all over the place.
And that really does have at least least half of it, a really hawkish tilt right now at a time when other people are saying, you know, we'll do it for the Fed, mission accomplished. So it raises this question, at this point, what is keeping them from really going all in on the immaculate disinflation? Is it just PTSD from Q1? And will all of the sort of questions that people have around the hawkishness just disappear in the wake of the bomb that Jay Powell tends to bring us?
Mike Gapen of Bank of America is with us now for more. Mike Gapen, I was sharing your words a little bit earlier, that quote from you, one giant leap for the Fed. Then I explained that you still don't think they cut until December, so it's not that big a leap. What do you make of what you've heard in the last 20 minutes or so?
Well, if we thought it was September or sooner cut, maybe it'd be one giant leap for mankind instead of the Fed. Like I think what Bob and Mohamed have been saying here, I think I would share, which is I think the data is probably more important than the dots in this case, because it is such a data-dependent Fed. They don't want to take these structural longer-term views, so they'll be reactionary. So maybe that the dots kind of lag what's happening on the ground. Look, I would just characterize all this as an incremental shift in Fed thinking, that they were trying to target us to the middle of the year. Inflation didn't cooperate, so they shifted things back. I would encourage them, like Mohamed is saying, to take some stands on longer term structural views, but this is not the Fed that we have.
Michael, how exposed are they? I go back to the Bank of America work of their very retired Ethan Harris's wonderful book, Ben Bernanke's Fed. Okay, great. Are we still back at Ben Bernanke or Alan Greenspan's Fed, where they are exceptionally exposed?
I don't think so. I just think it's they believe, I think as you're noting in the dots, there's a wide disparity of views, and sometimes pulling the view out of the median is a fool's errand. So it may just be that there's not a lot of structural or agreement about these longer term structural issues, so it's hard for them to be forecast based. And so you just get a plethora of views, and so they throw their arms up and say, fine, there's a lot of uncertainty. The only thing we can trust is the data under our feet, so that's what we'll focus on, for better or worse. Michael,
what would be your question to Fed Chair Powell this afternoon?
How much was the data this morning reflected in the projections and the dots? If the answer is yes, it sounds a little hawkish. If the answer is no, then you can make a case for September still being on the board. I think the data could make a September cut viable. We just think it all comes together in December. So the dots and the forecasts are kind of a Mike forecast right now. So I'm pretty pleased with those.
Mohamed and Bob have got the same thoughts. Let me tell you. Mike Gapen of Bank of America. Mike, thank you, sir. Mohamed, I wanted to come across to you on the forecast, but not on the dots. I wanted to talk about unemployment. When they reflect on what we learned on Friday, and you were with us working through that payrolls report, just the difference between the two surveys, how do you think this FOMC is navigating that at the moment?
I think it's navigating like everybody else, trying to maintain optionality, trying to understand what's going on. And it's not just the employment data. We've had a lot of competing macro data. So, they're just waiting. I do think there's two things going on. Certainly the uncertainty is making them data dependent. But there's something else that's making them data dependent, is what happened in 2021. When they did take a view on inflation, they took a strategic view on inflation, and it turned out to be really wrong. And I think they've been burnt, and they don't want to go back to that fire anytime soon. So they will not be trying to reconcile the data. They will not be trying to anchor markets and their own thinking with a forward-looking view. They're going to continuously react to the latest set of data. And that's what I think you're going to see.
Which could be good and it could be bad, according to you, Mohamed. Bob, I'd love to bring you back in. At a time when it seems like this is a Fed wrestling with itself, the consensus on the top is a mirage. Sure, there's a consensus not to cut rates at this meeting, but that's pretty much it. What does that signal for you in terms of the clarity of purpose of their policy going forward and how to really navigate around it?
Great question. If I were Mike McKee, I'd ask the Fed, have the summary of economic projections outlived their usefulness? Do they do more harm than good? And if the answer is no, then I'm sitting here, we're told to look at the summary of economic projections, and it's reflecting a Fed that's confused. And you know what? Even if they submitted the projections before the CPI data, one bit of data shouldn't create that much of a change. So this is a confused Fed. What that tells me is the bond market is in the hands of people like me. I don't know what the Fed's thinking. I don't know what they're looking at. I don't know what they're going to do. All I know is current levels. I know our projections of where growth and inflation are headed to. I know the amount of buying that's going on now. I know who's waiting on the sidelines. I look at this. It tells me I certainly don't want to be short duration or underweight relative to benchmarks. I want to be somewhere around neutral. I want to be concentrated in the front end of the curve. And I like credit because everything's telling me we're gliding into a soft landing, and that's good for corporate America. It's also good for corporate Europe.
Dr. El-Erian, help me translate this, and you can do this out of the Pepys Library, Cambridge. What in God's name is modest further progress?
It is changing a phrase that used to be somewhat more hawkish to something that is less hawkish but not dovish. That is what that is.
Mohamed, you've said for a while that maybe they're making a mistake, that they haven't taken this strategic view, and you were hoping they'd go sooner rather than later. Can you help us understand the difference between not going three but going once, and the difference between doing that one cut at the end of the year as opposed to doing it in July? What difference does 4 or 5 months make?
So I love listening to Bob Michael's, or is it Bob Michele, John, as you told me last time? Anyway, I love listening to Bob Michael's soft landing scenario because it's very soothing. But analytically, based on how I assess the economy, I give it a 50% probability. It is the dominant scenario, but it is not dominant with high probability. So I have to have a risk mitigation mindset. And then when I look at the tails, I see the tails of recession being larger than the tail of bigger but not hotter economy.
Bob Michael, your take.
When I look at that distribution and I look at the asymmetrical tails, I start asking, what are the buffers in the economy? And that's where I start getting worried. And that's where the delay of the rate cut means that those buffers that are already quite limited among small businesses, among low-income households, get eroded really quickly.
Mohamed, you've been around as long as I have. You're right. We've only seen one soft landing in our investment career, and this is 40 plus years, and that was in '95. So soft landings are incredibly hard to engineer. In fact, just the probabilities are way against you. But what worked in '95 is, I think, what you're alluding to. The Fed came in and started cutting rates. They cut rates 75 basis points in '95. It was just enough to take the pressure off of businesses and households, and thus we had, I believe, the only soft landing in our careers.
Mohamed, we've got enough time to give you the final word.
I love what Bob just said. Thank you, Bob.
Mohamed El-Erian of Queen's College, Cambridge. Mohamed, thank you. Not sharing that. Neil Dutta of Renmac just writes in, the Fed thinks unemployment is going to be flat for the rest of the year. Good luck. That's the take from Neil today.
Yeah, he thinks that this is the beginning of a pretty rapid weakening and the Fed needs to cut next month. What Bob said, I think we have to sit on it for a second. He said that he, as bond guy, is taking control of the market. The Fed is no longer in control because it is a confused Federal Reserve, and the bond kings are over there just cleaning up and figuring out what the supply, the demand is, and the technicals. This is a new world, which is the reason why yields have been swinging around like penny stocks, because essentially the Fed is not the guide anymore. It's a battle of wits and a battle of vision that you have between different bond kings.
OK, if this wild bond market, if this treasury market behaving like a penny stock is someone in charge, can you explain that to me a little bit more? How are investors in charge of this bond market? 1 minute it's hot, yields are flying. The next minute it's cold and yields are diving.
That's right. There isn't any central planning right now. And that's what you get. And you don't have the absorption tool of a lot of the big banks because their balance sheets are smaller. So what you get is that whipsaw kind of action of no one in control, of a lot of people taking charge, but no one in control.
They'll say we're data dependent. This is what it's all about. The market's just reflecting the incoming data.
Correct.
From data point to data point.
Correct.
This is by design, a feature and not a bug.
So when is that a problem, right? We even heard James Bullard saying this is potentially a problem if you have this degree of volatility in the benchmark rate for the entire world, as we saw earlier this morning.
2-year all over the place. We're down 12 basis points today, 471. In just a moment, that door's going to open and Fed Chair Jay Powell's going to walk in. There's going to be a lot of questions, but the number one question we all have in the last 30 minutes is, did you factor in the inflation report that came out at 8:30 Eastern Time into the forecast you just unveiled 30 minutes ago? I don't think there is another question to ask in this press conference once it starts.
And Michael Gapen put it really well. If the answer is no, we did not, well, it's not that hawkish. If the answer is yes, we did, that is a hawkish tilt at a time where a lot of people view that as progress and even reason to celebrate success.
The most important thing I heard was from Bob Michele, and it was him talking about parts of America.
A new name for Bob now.
It's a new name. Talking about parts of America that are not enjoying this financialization. They're not enjoying it as haves. And to me, John, that's a key issue.
Here's the chairman of the Federal Reserve.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so What's going on there is that we had very low readings in the second half of last year, June through December, really. And we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Tamaros of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible. But I'd look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly more good inflation readings will help with that. I'm not going to be specific about how many because, really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. And I'm not going to get into the specifics, but you have the ability to do that. So that what's in the SEP actually does reflect the data that we got today, to the extent you can, reflect it in one day. I think we'll see PPI tomorrow. We'll know more about the PCE reading as the month goes on. But the initial CPI reading and its, kind of first level translation to PCE, we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
John Allen. Hi, Chair Powell. Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit, and that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand. And that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. How can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier in the, what did we take away from this? We had really, really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. You know, there are fewer rate cuts in the median this year, but there's one more next year. So if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. You know, the economy has repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina.
Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star is a very important concept in economics and in what we do, but honestly it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now. But ultimately, we think that things like the neutral rate are driven by longer-run, slow-moving forces, and there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate. And we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal, and then for a while there was a pause, and we look at today's thing and we think, well, that's that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking, and that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down, really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that, though. We're look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. That's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation, with growth at a good level, and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market, while we're continuing to make progress on inflation. So, we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. Ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can
on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and we've taken some signal from that. But and of course, housing services, you're continuing to see high readings there. To some extent, that's catch-up inflation from earlier pressures. But overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions. And the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully. And we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We you always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month, and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably on 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Jolene.
Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows has a definitive answer why people are not as happy about the economy as they might be, and we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people who are at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, and particularly the second half of last year, and we continue to see still strong growth, or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that. And that's not what happened. Instead, the U.S. is, anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about your second question was really about shelter inflation. So. I think if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents that has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It just is going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at, It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward. Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what that you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home. But households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And, what do we see? That's what we see. We see the same data that everybody else sees. But you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as it's spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done. Ultimately, to get inflation under control, because those people experience inflation, very directly, very painfully, and once we get inflation under control, rates can come down, which will also improve things.
Victoria.
Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market has the ability, has the tendency sometimes to move, to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So, and also the fact that we look at all of the whole situation. So, a decision to begin to loosen policy could have several reasons associated with it at a given time. But I would just we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I mean, I can think of things that many things would make it on that list, but I don't think I'll utter them here.
Thank you, Chair Powell. Simon Urbanovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I get that, as many good ones as we had bad ones, but no, it's not like that. It's it's going to be the totality of the data. The labor market data, the growth data, in terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things because that points to dates, and I just don't think we're not at a point of being able to do that.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the market should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't. Actually, it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, and for our economy, what we're trying to foster is maximum employment and price stability, and we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE, or at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation.
So we're well aware of the two-sided risks here. Let me just say we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there, and we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low, so we have the ability now to approach this question carefully, and that's what we're doing.
Just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Evan.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing. And all the other details, we don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't. There isn't any one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or, alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example. And we don't target wages. We target aggregate prices and overall employment. So,
but if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you'd look at we'd be looking at the aggregate numbers, and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
The chairman of the Federal Reserve, Jerome Powell, wrapping up the June Fed decision. No change at the Federal Reserve to interest rates. Plenty of changes in the forecast. Inflation moving up a little bit. The dot plot moving down a little bit. Equity markets just about holding on to gains and still near all-time highs on the S&P 500. On the Nasdaq, we're still higher by 1.8%. The Russell up by 2.2%. If we turn the page and switch to the board and get to the bond market, this is where things start to get interesting. Yields were down by double digits at the front end throughout most of the morning and into the afternoon. We're now down by only 9 on a 2-year at 474.55. And if you take an intraday chart of the 2-year yield, this shows the story of the morning and the afternoon perfectly. I want to show you 3 moves. The first move was 8:30 Eastern time this morning when CPI came out cooler than expected. What you see on yields? Drop. Easy to see. On the far right side of the chart, 2 moves I want to point out. One's at 2 p.m. Another is in the news conference. At 2 p.m., we had some forecasts. The dot plot came out, and we all wanted to know where the median dot would be. In March, it signaled, or at least implied, 3 cuts for 2024. That came down to 1. Yields started to climb. And then we all had a big question going into the news conference. Well, hang on a minute. Did they factor in the inflation report that came out this morning? And obviously, inevitably, Chairman Powell was asked about it. This is what he had to say.
What's in the SEP actually does reflect the data that we got today, to the extent you can, reflect it in one day. I think you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on. But the initial CPI reading and its, kind of first level translation to PCE, we did have this morning. We were briefed about it, and people were able to consider whether they should make changes.
And it didn't look like many people made any changes, Lisa. And for that reason, that's why you see that spike higher, that little move higher, again on a 2-year yield. Cue the confusion around the forecast.
Well, is this by design in some levels? Basically, there were a number of Fed officials who got that CPI print and opted not to change their inflation forecast. Did they do so because they want more than 3 inflation reads to really gain confidence in some sort of disinflationary trend? Is it because, all things being equal, it's better to send a hawkish signal to markets that are eagerly looking for any opening to buy into any idea of a rate cut? All we know is that that was a slight disappointment that's being reflected in slightly higher yields that have taken back about 5 basis points from earlier this morning.
There's always going to be a big conversation about where the median dot is. But when these numbers came out, you were the first to point this out. The split amongst the policymakers elsewhere. TK, just to go through this again, for those of you just joining us, this is what we saw. Get away from the median. On the committee right now, the dot plot shows 4 policymakers who saw no cuts this year. Some anticipated just 1 reduction, that was 7, and 8 expected, Tom, 2 cuts. The Federal Reserve is kind of all over the place.
Yeah, they're bifurcated. And what's important here is the dispersion is not smooth. It's like basically 2 camps. I thought Luke Kawa, of all people, had a wonderful tweet out on this, really pointing out the polarity that we see in the Fed as we stagger through the summer.
Kathy Jones and Charles Schwab is with us now to weigh in on some of what we heard in the news conference and what we saw in the release at 2 p.m. Eastern Time. Kathy, your thoughts on this one, please. I think we've got a problem with her microphone. Hopefully we can address that. Kathy, we'll come back to you in just a moment. I want to pick up on the labour market and talk a little bit about that. So on Friday, payrolls came in and it looked really hot. On the headline number, 272. But there's 2 surveys that go into payrolls. There's the establishment survey, payrolls. There's the household survey. That's the unemployment rate. Unemployment came up to about 4%. We all wanted to know what weight would Chairman Powell put on the headline figure and how much weight would he put on the household survey. And he kind of said something like this. Sometimes it's difficult to reconcile the differences. Payrolls might be a little bit overstated. Makes more sense to look at things over the last 6 months or so, Lisa. Overall, the picture is strong, and we've got a gradually cooling labour market.
People really honed in on the idea that the payroll jobs growth may be overstated. That line caught a lot of people's attention at a time where he reflected the confusion that we all felt, which is the reason why some people said, we don't believe these numbers, we'll wait for the revisions. Nonetheless, this is why he's talking about a series of data points, and maybe is part of the reason why they aren't having much conviction, because this is just sheer confusion that we're feeling from the Fed.
Do you remember when Diane Swonk used to talk about aspirational forecasts of the
Yes.
Federal Reserve? Let's have a look at unemployment together. 4% on Friday. This is where they see it year end. Median projection, 4% year end 24, 4.2% year end 25. Lisa, year end 2026, 4.1%. Now, I understand the Federal Reserve has a great influence on things. They can shape the events they anticipate. If they start to signal that unemployment's going to 5%, we've got a problem. And I think you see the market freak out. But to signal, based on your own projections, that we finish basically flat from where we are on unemployment by year end and climb to 4.2 by 2025, is that aspirational or realistic?
You know, we said a lot of their projections were aspirational a year or 2 years ago, and yet they were correct. So I'm humbled to sit here and say that they're just purely aspirational when we have not seen the unemployment rate climb to such a significant degree. And they've actually had to decrease their expectation for unemployment rates just simply because the labor market was stronger than they expected. Now, I would argue that the idea of upgrading their expectation for inflation and keeping the same number of cuts, just pushing them back to a later time, raises some questions. And this was asked at the press conference. How do they accept that, given that they don't see the labor market breaking and that they want to get back down to 2%? How do we thread that needle? And that's a good question that I didn't really hear an answer to.
Mike McKee's run out of the news conference and got in front of the camera for us. Mike, let's catch up with you. Chairman Powell, did he manage to square the circle in that news conference?
Not really. John, I was thinking during this of a line from the old movie Blazing Saddles where the preacher says, "You're on your own, boys," because there doesn't seem to be any kind of direction here from the Fed about which way they're going to go and when. They're still their base case, as I mentioned in my question to the chairman, is that they're going to cut rates this year, but they don't see any difference at the end of the year between the economy now and the economy then. So how are investors supposed to anticipate what the Fed's going to do if the Fed doesn't know and can't give you any guideposts? The chairman said, well, we need a couple more reports that show things improving. But what is improvement? Last month, we saw the CPI change by about 1/10 of a point, and the PCE changed by about 1/10 of a point. And Chris Waller said, well, that's not good enough. I give those reports a C+. So it's really hard to tell what's going to move them. Obviously, he's sort of signaling not July, but from September on, it's an open question.
Mike, they want the convenience of a dramatic ex post decision. Maybe that's not the way the script goes this time. What will you watch in the data that allows them to get out front as they've never done before? Well, maybe the 90s, but basically that they've never done before.
Well, basically, you want to see what they want to see, an improvement in inflation data, but how much is going to be the tricky part. We'll have to watch both what the market reaction is and what the data show, and then what they say in their speeches. At the same time, we will also be looking at the unemployment rate and job creation to make sure things don't go south there. Either one might push them one direction or another. I think that at this point, they're going to be as cautious as possible, but they do seem determined to get at least one cut in.
Mike, a lot of people were asking, including both Mohamed and Bob Michael, whether the Fed officials really understood the CPI data and kept their projections. We got kind of an answer, but Seema Shah put it this way. You know, if they did know that, maybe that implies that they need more than 3 months of softer inflation prints before they can be convinced to cut rates. Do we have any clear message from the idea that, yes, Fed officials had the information, and yes, they had the chance to change their forecasts, and no, they did not do it?
Well, the chairman suggested that some people may have changed their forecast, but the majority didn't. It's not going to be extending the number of inflation data that they get. It's going to be more of the same that we saw today. It doesn't have to be maybe the same magnitude, but it has to be a continued sequence of slowing inflation for them to gain confidence. That's their magic word, is confidence, and they don't tell us what would give them confidence, but it seems like several more, 1 or 2 more maybe, would give them the confidence that they could start moving towards cutting rates.
Mike, you're an expert at the data, far more than I am. If you look at domestic final sales, take out the noise of trade, the world's agony, et cetera. If you look at domestic final sales, what's the run rate on the economy that they're going to be dealing with to July 31, September 18th, and near the election, November 7th?
Well, we were still in that area, Tom, 2.8% in the first quarter, still well above trend growth for that. And the Atlanta Fed GDP now is running above 3%. If you take that one and you take the first quarter GDP and average them, you're at 2.2% for the first half. So they're going to be dealing with, and they predict they're going to be dealing with, an economy that doesn't slow down at this point and doesn't affect the labor market at this point. And the interesting thing is they see core PCE inflation going up, but they're still talking about raising rates, or cutting rates rather. So it's a situation that kind of leaves everybody at sea here as to what it is they're actually going to do. If they wanted to advertise, listen to our speeches, this is a good advertisement for that.
Yeah, Mike, I'm not sure if that one bites. Let's see if that works. Mike McKee, thank you, sir. Great work, as always, in the news conference once again. This is the calendar for the next month or so. So July 5th, you get another jobs report. Let's see if it looked like the one we got on Friday. July 11th, you get a CPI report. Back end of July, very last day of the month, July 31, another Federal Reserve decision. No questions really about July, Lisa, but I guess it was implied based on the forecast we got a little bit earlier.
Basically, it seems like July is squarely off the table. It was not even a consideration. September, though, Jay Powell didn't even entertain that idea. He kind of hemmed and hawed. I don't want to talk about time frames. We don't want to be like, you know, squared in,
I'm
given
sure
the fact
Powell
that we
would
want
love
to be
this
flexible.
impression of him.
Well, I mean,
Again.
honestly, that was exactly what he needed to do, right? Wasn't that kind of the goal that Bob Michael set out for him, was to do nothing? I mean, if anything, he had the most hawkish message relative to market expectations in a long time. So it was somewhat of a different Jay Powell than we've gotten in the past. But, you know, he wouldn't really solidify anything. And that, I think, was by design, given their confusion.
I think emphasis really matters in news conferences, of course. It matters. It's pretty straightforward. It's where he didn't put the emphasis. He didn't really put much emphasis on the forecast for economic growth, unemployment, or inflation. Where he actually put emphasis was on the destination for the Fed dots. And I thought it was pretty interesting. So we were all sort of geared up to focus on 2024. Would the dot plot, the median dot, come down from 3 to 2, maybe to 1? It comes down to 1. But then you're looking out to 2025, and they give you 1 back. So they take 2 away and then throw an extra 1 in 2025. So really today, when you look at the dot plot, the ultimate destination, what's changed for the FOMC just in terms of the path for rates from here?
Basically, just the disinflationary trend is happening more slowly than they previously thought, but that at some point they will have this same trajectory just on a delayed time frame. And that was essentially what Jay Powell laid out today. And maybe on the margins, that's a bit more hawkish than the 2-year was pricing in before.
I'm going to go to modest further progress. Modest is on the y-axis. I have no idea what it means. Further in progress, John, is exactly what you were talking about, which is what they're doing here is they're extending out the optionality of their timeline, their x-axis. Because to your point, Lisa, this disinflation, it is slower. David Rosenberg, not the next Rosenberg, David Rosenberg says eureka, but what they did today was extend out the x-axis with further progress. That's not in any textbooks. That's marketing baloney as far as I'm concerned.
We can get to Jeff Rosenberg right now at BlackRock. Jeff, wonderful to catch up with you, sir. Let's get into it. What did you make of these forecasts, and can you square the circle for us?
You know, I agree with Lisa. It's a little bit hard to square the circle here from the press conference. I mean, obviously, the morning's data set the tone for a very dovish press conference, and the 1 hike median kind of took the wind out of the sails, and so Powell was kind of faced with that as the backdrop, and so it was maybe a little bit less of the dovish Powell than we've seen in the past. But I think he did give us a couple of insights. One, he did talk about the overstatement argument on payrolls, you know, a little bit to last week's data. 2, you know, he talked about 2.6, 2.7 as being, I can't remember exactly the quote, a fine place to be. And I think that does reveal that this is a Fed that doesn't have to get to 2% anytime soon. And that's part of this asymmetric response function. If inflation is a little bit too hot, then we'll just hold pat. And if there's weakening in the labor markets or any kind of unexpected weakening, then we're going to cut, and we'll cut more aggressively. And so I think they're comfortable with this path of inflation. And then I think on the third point, there's just a bit of confusion about how stale are the SEP forecasts relative to the new information from the morning. I think what is clear here is that having been a little bit burned by the enthusiasm at the end of last year and then the reversal on inflation, they're not going to want to reverse so quickly with just one good print. And he stated again and again they'll need more than just one, and I think that's why you had maybe the hesitancy. But understand that the difference between 2-cut and 1-cut median is 1 member. This is a very fine point to be seeing, you know, pretty big shifts in market pricing. I think the broader theme here is this is still a Fed that is looking to cut rates, very supportive to financial markets. Obviously, the data this morning is supportive to that. A little bit dismissive about the strength of the labor market, so I think this is a pretty good setup here for bonds and stocks.
Does this mean, in your view, that September is still very much on the table, even if Fed Chair Powell really demurred when it came to a time frame?
I do think it is, and I think obviously, you know, this is the volatility that is what happens when the data lights the way, when you're completely abandoning forecast-based policy for data dependence. But if we do get in the interim period between now and September, reports that are along the lines, we don't have to get as big of a downside surprise as inflation as we've seen, but that continued gradual rebalancing of the labor market, stabilization to slowing on the inflation side, then I think absolutely September is in play, as well as December and the 2 cuts that are, you know, not in the median, but I think are still very much in play here.
Jeff, when he stepped off the stage, we were up 2.8 standard deviations on both SPX and NASDAQ 100. We've pulled back a little bit from there, selling into the excitement tomorrow morning, I guess. Jeff Rosenberg, simple. How do you invest in this? Do you just clip a coupon? Do you go to do you increase your cash level in this uncertainty? Is there an opportunity?
Well, I think, as I mentioned, the opportunity here is that this is a Fed that is very asymmetric, and they're asymmetric with regards to holding policy flat in the face of disappointing data in terms of strength or policy progress on inflation, and then very supportive on unexpected weakening in the labor market. I think that's very supportive to financial market conditions. I think there's a longer run, problem with that potentially, but in the short run, this is a little bit more favorable to risk markets and to risk taking. You can step out of cash into that front end of the curve. This is a Fed that's telling you that they're going to cut rates. So cash has been very supportive because they've held rates up. But the path going forward, and Jonathan mentioned it, this is just shifting the cuts into 2025. So you're going to lose the income by hanging out in cash. The belly of the curve for fixed income investors, the front belly of the curve, 2 to 5 year part. I think that's a very attractive part of the curve. I do think you have to start moving out into that part of the curve to lock in those rates. And the economy, to the comments on Mike McKee, GDP Now, the forecasting, above trend growth relative to the fears of recession. This is a very supportive market environment for credit. That's a carry argument. I think you can clip coupon there, take some risk there because the default risk is still very much low because the growth side of the economy is very strong.
Jeff, stay close. I'll get you back in just a moment. I want to talk about 25 by talking about 24. There's 4 meetings left this year. July 31, September 18, November 7th, December 18th. I want to go to the November meeting. November 5th is an election. The day after, they kick off a Fed meeting. Michael McKee, we're all talking about forecasts for 2025. None of us have got a clue, have we, about what 2025 is going to look like?
Well, you take a look at the dot plot for 2025 and compared to 2024, it's very, very spread out. There is no consensus at all. We pick a median for convenience and talk about it, and we say, okay, they're putting us up to 4 rate cuts next year. But really what the dot plot is telling you is they have no idea. And one of the reasons is we could have a completely different fiscal policy next year. And we have a lot of issues, including debt ceiling, the government funding, and the tax cuts that are going to expire that could change the economic picture tremendously. So I'm not going to tell Jeff Rosenberg how to trade that, but I don't think you can have a whole lot of confidence that what they're predicting today is going to be anything like what we'll be seeing at the November meeting.
And Mike McKee, thank you, sir. Of course, the forecasts are always more instructive to really gauge the reaction function. That's what's important here, how they respond to incoming information. But let's just run with this. The forecast for 2025. Bramo, what are they worth, given how much could change in November onwards?
Well, this is the reason why Bob Michael said, I'm in charge here. I'm a bond market investor, and I'm the person who sets the rates right now, not the Federal Reserve at a time where they are just as confused as ever before. I am curious, Jeff, what is your take on that? That right now we see big bond investors saying we're setting rates. The Fed is a bunch of confused people who are looking at the same data and equally confused as everybody else. We can look at supply and demand. We can react to all of the economic data. Sure, yields jump up and down, but we're the ones that are kind of the main guy in the room.
I'm going to agree with Bob Michael very much so, especially when we're talking about the back end maturities and the term premium. This is a Fed that's going to get less into the business of setting term premium and influencing the maturity of rates and the difference between demand and supply, particularly as Mike McKee was just mentioning, we're going to have a big issue around fiscal deficits and their financing, and much more of that is going to be borne by us, the bond market investors, the private sector. So a lot more of that term premium, and then resetting that term premium is going to be dictated by financial markets. It's partly why I think the front end of the curve is a bit more attractive because the term premium, you're going into that uncertainty with relatively low, yes, we're off the historical lows, but relatively low compensation for both term and inflation premium. I think that makes the back end a lot more challenging, and because we view it as more challenging, there's less demand, you're going to have more supply. I think that could be a factor towards a little bit longer run process of steepening out both term and inflation premium in the back end.
Jeff, what's important here, and you said it, that there's a risk-on feel to this, and certainly we've seen it in technology, and SPX before he ended his press conference up well over 2.8 standard deviations. Is the answer here, Jeff, that everything is just plain solid? There isn't the polarity of a boom economy or doom and gloom. It's just a solid American economy?
It's pretty solid, Tom. I mean, when you look at that domestic demand component, and it's so solid that, last Friday when I was on, we talked about the question that was asked a bit today, how restrictive is policy? Really, you're not really seeing it in the economic slowdown that you'd otherwise expect outside of the interest rate sensitive sector. So for risky assets and for credit, as I just mentioned, I think that's a good thing. So I do think that the strength of the economy here helps to underwrite some risk-taking in a broad sense, and there's a bit of a worry there that may be leading to maybe less progress on inflation. But I think what we heard from the chairman today, they don't need, yes, they're going to say we want to maintain policy and get back to 2%, but it could be a long period of willingness to accept 2.5% to 3% as good enough. Take the win. We've come from 7 down to below 3. That's a good outcome, and not risk the economic growth side by over-tightening.
Jeff, love doing this with you. Thank you, sir. Jeff Rosenberg there of BlackRock, wrapping up Fed decision day and CPI morning as well. Let's get some final words around the table. TK, first to you. Final thoughts.
It's going to be eventful through the rest of the year. I thought it was off of CPI this morning, just spectacular. Yes, they're data dependent, but you know what? It's going to be eventful right up to Jackson Hole and beyond.
Anyone who is looking for some sort of certainty in the bond market, some sort of stability, good luck. Because right now you have a green light to go crazy, to see bonkers types of moves, to quote one of our guests earlier this week. Because right now there is no central planning when it comes to where rates are going. And that to me is significant at a time where at one point that was considered a financial stability risk. Right now, it doesn't seem to be. I don't know if that's a sign of strength or fragility, but right now, that is the takeaway. These double-digit moves in yield on a daily basis, they seem to be here to stay.
Well, right now, we're giving some of that up.
Correct.
I just recapped some of the price action. Session highs on the S&P 500. About 20 minutes ago, we were higher by more than 1.3%, now positive by about 0.7% on the S&P. In the bond market, at the lows on a 2-year yield, we were down 16 basis points. We're now down about 7 or 8. So some of this unwinding just a little bit. The team's going to take over from here. They'll run you through the close. They'll catch up with former Fed Governor Betsy Duke and Jim Chanos. Look out for those conversations. From New York City, that's it for us. We'll see you at the end of July. We're all away until then. From New York, this was The Fed Decides.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing.
but what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world, and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?